ICICI Bank, India's banking giant, still a buy in 2026. When investors discuss India's best private banks, three names usually come up: HDFC Bank, ICICI Bank, Axis Bank. But over the last few years, one bank has quietly transformed itself from a troubled lender into one of India's strongest financial institutions. That bank is ICICI Bank. Today, we'll analyze business model, growth opportunities, financial performance, asset quality, valuation, risk. Whether ICICI Bank is a buy, hold, or avoid in 2026. Let's begin. Understanding ICICI Bank. ICICI Bank is India's second largest private sector bank. The bank serves retail customers, SMEs, corporates, rural customers, wealth management clients. Products include saving accounts, current account, home loans, personal loans, auto loans, credit cards, business loans. The bank earns money mainly from net interest income, that is, borrowing at lower rates and lending at higher rates. Fee income, credit cards, wealth management, insurance distribution, forex services, transaction charges. This creates multiple income streams. The transformation story. A few years ago, ICICI Bank faced high NPA, corporate loan stress, governance concern. Investors preferred HDFC Bank. Then management changed. The bank shifted focus towards retail lending, digital banking, better risk management, stronger underwriting. Result? One of the greatest turnaround in Indian banking history. Today, ICICI Bank is considered among India's best run banks. Growth story. India remains underbanked as income rises, more home loans, more credit cards, more vehicle loans, more SME finance. ICICI Bank benefits from all these trends. Retail banking, retail loans are safer and diversified. Growth areas, home loan, auto loan, personal loan, credit cards. Digital banking. ICICI is among India's most advanced digital banks. Benefits are lower operating cost, better customer retention, faster loan approval. Wealth management. As India becomes wealthier, investments grow. Insurance penetration rises. This creates fee income opportunities. Financial performance. Let's examine the numbers. First, loan book growth. Over the last several years, consistent double-digit growth, strong retail focus. For FY26, the total loan book is 15 lakh crores. The growth is 15% year on year. Strong growth in home loans, vehicle loans, business banking, corporate lending. Verdict is healthy credit growth indicates strong demand and market share gains. Deposit growth. Deposits are the raw material for banking. ICICI continues attracting deposits through branch expansion, digital channel, brand trust. The total deposit for FY26 was 17.9 lakh crores. The growth was 11% year on year. The CASA ratio is 38%. Verdict: deposits are growing steadily, supporting future loan growth. Profit growth. Profits have increased significantly due to lower bad loans and higher loan growth. Better margins. Profit growth for FY26, the net profit was 50,000 crores. The growth was 6% year on year. For Q4 FY26, the net profit was 13,000 crore and the Q4 growth was 8.5% year on year. Profit continues to grow, though at a slower pace than previous years. The bank has become a compounding machine. Asset quality. This is where great banks separate themselves. Gross NPA. Gross NPA has fallen drastically. Years ago, investors worried about bad loans. The gross NPA for FY26 is 1.41%. Asset quality is among the best in the sector. Next, net NPA. Net NPA remains extremely low, meaning most loans are performing. The net NPA for FY26 is 0.33%. Provision coverage. The bank maintains strong provision. The provision coverage ratio is 75%. This creates a safety cushion during economic slowdown. Excellent asset quality, among the best in the banking sector. Capital strength. Capital adequacy ratio is 17%. CET1 tier ratio is 16%. Strong balance sheet with ample capital for growth. Net interest income. Q4 FY26, the NII is 22,000 crore. Growth is 8% year on year. And net interest margin NIM is 4.32%. One of the strongest margins among large Indian banks. Overall scorecard, profit growth is 4 star out of 5. Loan growth is 5 star out of 5. Deposit growth is 4 star. NII growth is 4 star. Asset quality 5 on 5 and capital strength 5 on 5. ICICI Bank remains one of India's highest quality bank. It is delivering double-digit loan growth, strong deposit growth, very low NPA, high profitability, strong capital adequacy. Return ratios. First, return on equity. Return on equity is 16%. ROE measures how efficiently the bank generates profit from shareholders' equity. For ROE of 16% in FY26, which is consistently above most large Indian banks, indicates strong capital allocation and profitability. Verdict is excellent. Anything above 15% for a large bank is considered very strong. Second, return on asset. ROA is 2%. ROA measures profit generated from total asset. For FY26, ROE is 2%, among the highest in the Indian banking sector. Reflects strong lending quality and operational efficiency. Verdict is outstanding. A ROI above 2% is rare among large banks. The bank has maintained excellent return ratios while continue to grow loan and deposits. Competitive advantage. Advantage 1. Strong brand. Millions trust ICICI Bank. Trust matters enormously in banking. Large deposit base. Cheap deposits improve profitability. The larger the deposit franchise, the stronger the competitive moat. Advantage 3. Technology leadership. ICICI invested heavily in mobile banking, AI-driven services, digital lending. Technology improves customer experience. Advantage 4. Diversified business. Revenue comes from retail banking, corporate banking, credit cards, wealth management. This reduces dependence on any one segment. Valuation analysis. For banks, mostly price to book value is used to analyze. At current valuation, the share price is 1340. The price to earning ratio P is 18 in FY26. The price to book value PB is 2.5 to 2.7. ROE, return on equity, is 16 to 17%. P valuation below 12 is very cheap. 12 to 15 is cheap. 15 to 18 is fair value and 18 to 22 is expensive. Above 22 is very expensive. The current PE is 18. Fairly valued to slightly expensive. Not a bargain but not overheated either. PB valuation for banks, price to book is the most important valuation metric. Below 1.5 is very cheap. 1.5 to 2.5 is fair value. 2.5 to 3.5 is expensive. Above 3.5 is very expensive. The current PB is 2.5 to 2.7, which comes under expensive category. Premium valuation justified by strong asset quality and profitability. Risk. No investment is risk-free. First, economic slowdown. If GDP growth slows, loan demand falls, NPAs may rise. Risk 2. Deposit competition. Bank compete aggressively for deposits. Higher deposit cost can pressure margins. Risk 3. Regulatory changes. Banking is highly regulated. Policy changes can affect profitability. Risk 4. Fintech competition. Fintech companies continue targeting payments, lending, wealth management. Though large banks still retain significant advantages. ICICI Bank today is well managed, strong balance sheet, excellent asset quality, strong profit growth, technology leader, beneficiary of India's long-term growth. For long term investors, ICICI Bank remains one of the highest quality banking franchises in India. Will it double overnight? Probably not. Can it compound wealth steadily over the next decade? Very possible. As Warren Buffett says, it is far better to buy a wonderful business at a fair price than a fair business at a wonderful price. ICICI Bank looks much closer to the first category.